Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, January 7th. The first Monday of the year was marked by a technology rally, stronger than expected German inflation numbers due to the rising energy prices in Europe, and a softer US dollar despite higher US yields. So the US jobs data that will start flowing starting from today will either give reason to the Fed hawks who expect the Federal Reserve to take a long pause to its rate cuts this year, or allow the market to scale back a part of that hawkishness. Okay, everyone, so welcome to the new year. I hope everyone had a nice start to this new year. So, the new year kicked off on quite a volatile note for the US equity markets, to say the least, because they actually spent the first day of trading of the year diving. But happily, since then, the market mood has greatly improved because the worries that the AI rally would fizzle out were rapidly wiped out at the start of this very week by Microsoft's announcement to be willing to spend 80 billion US dollar on data centers, which actually pushed the stock up to 1.40% at yesterday's trading session, by Foxconn announcement of a 42% surge in its December sales thanks to the AI-driven demand, which pushed Micron 10% higher yesterday in the US and Foxconn 3% higher in Taiwan today, and also by the news that Qualcomm is now introducing new chips that only cost $600. Yes, $600 with 2 zeros to power personal computers that are capable of running the latest AI software. So Qualcomm gained 1.28% at yesterday's trading session. And Nvidia in all this jumped 3.43% yesterday before the CEO Jensen Huang's CES speech and hit a fresh record high at yesterday's trading session. So that actually doesn't look like a rally that's fizzling out to me just yet. Although the AI discussions of this year will probably shift from hype and hope that we experienced in the first 2 years of the AI rally toward real life applications and toward return on these massive AI investments. So the data beyond the AI enablers like chip makers and chip equipment makers will likely command a larger share of investor attention this year, because what we want to see is AI tools to have better integration in our daily tools and obviously increased sales of companies who decided to incorporate them in their services. But for now, the AI enablers continue to shoulder the rally at the start of this year. So the S&P 500 kicked off the new week with a 0.55% advance, while its tech-heavy peer Nasdaq 100 gained more than 1% on Monday's trading session. Mood elsewhere was murkier, however, because the Dow Jones Industrial Index was slightly lower on Monday's trading session as the US 10-year yield spiked past the 4.60% level and the US 30-year yield hit 4.86% mark for the very first time since November 2023 on expectation that the Fed could make quite a long pause before its next rate cut due to worries, the good old worries of reviving inflation in the US with Donald Trump's pro-growth and tariff policies, while the US dollar couldn't really benefit from the higher US yields at yesterday's trading session, as Washington Post actually reported that Donald Trump's policies wouldn't be as harsh as he promised. But Donald Trump, being Donald Trump, rapidly denied the news and the dollar rebounded again. Then the USD CAD sharply fell on Trudeau's resignation yesterday, and probably also on the back of a rally that we saw in US crude oil prices that hit the $75 per barrel level yesterday. Woohoo! And I'll note that crude is now in the bullish consolidation zone and could eventually extend its gains towards 200-day moving moving average that stands near the $75.70 per barrel level. But coming back to my FX story, most major currencies yesterday spiked against a weaker US dollar. The euro dollar, for example, which tanked to 102.24 level in the early hours of the new year, has rebounded past the 104 psychological mark, while cable across the channel successfully threw itself back above the 1.25 mark. And well, the outlook for these currencies is uncertain, mind you, because if you haven't heard that just yet, I think you did, but the new year here in Europe started with quite bad news, because the first day of 2025 will actually mark the end of gas flows from Russia to Europe that flew through Ukraine. And we are having a pretty cold winter here, I'm telling you. Even the lowest ski stations in Switzerland, for example, that are mainly for children, are open these days, which is a grand source of joy for families. But European gas reserves are melting faster than average these days. And that's obviously pushing the natural gas prices higher on our European continent. So the European nat gas futures rallied up to 30% in the last 2 weeks of December. Obviously, we are nowhere close to the levels that we saw at the beginning of the war in Ukraine. But the fact that these gas reserves will be filled during the summer months keeps actually the outlook for nat gas prices positive and makes the price dips in nat gas, like the one that we saw yesterday, for example, interesting opportunities to strengthen long positions in natural gas. The only thing that could eventually reverse the gas rally right now is, one, the hope that the expired contracts will be renewed in the next few weeks. Then, on hope that Donald Trump will magically somehow end the war in Ukraine, and, well, or weak demand from China, which, by the way, well, recorded its worst start to a year since 2016. But coming back to Europe right now, the big problem here with these rising energy prices is that, well, it starts to be reflected in inflation figures in Europe. Because released yesterday, the German inflation spiked to 2.9% in December from 2.4% printed a month earlier. And the Eurozone's aggregate CPI data, that's due later this morning, will also probably show a similar upside pressure in inflation as well. And that's obviously not good news for the European Central Bank that's expected or that's supposed to give support to the weakened European economies this year by, well, providing them with ample rate cuts. Because if inflation spikes in the Eurozone economies, the ECB won't be able to ease the financial conditions in the Eurozone as much as desired. So that's obviously positive for the euro's valuation, but it should be negative for stock valuations in Europe. Now, the STOXX 600 index rallied to its 200-day moving average at yesterday's trading session, but note that a stronger than expected CPI number from the Eurozone countries today could spoil that optimism while allowing the euro dollar to extend its gains above the 104 mark and perhaps reclaim a rise toward the 105 psychological level. But the euro dollar's faith also, and heavily, depends on what's cooking in the US dollar leg, right? Because the US, well, will be releasing its latest jobs figures starting from today with JOLTS job opening numbers, and the numbers will actually matter because the US economic growth last year remained robust. The US jobs market started cooling, yes, but the cool down that we saw there was not as sharp and as bad as the Federal Reserve first predicted, which actually led them to cut their interest rates by an unnecessary 50 basis points last September, remember, to start with, and they cut by 100 basis points since then. Yet the US economy ended up by adding close to 180,000 new non-farm jobs every month on average during last year. So it's a good number, guys. As such, the potentially excessive rate cuts of last year from the Fed will greatly fuel today the expectation that the Fed will have to pause for a few months. So concretely, activity on Fed funds futures suggests today that the next Fed cut will not arrive before May this year. The thing is sufficiently soft figures this week from the US could actually scale back a part of that hawkishness and eventually pull the US dollar lower and allow the other major currencies to gain some more field. So this is all for today. I'm İpek Özkardeşka and thank you for joining me today. I hope this first episode of the year has been helpful and it has been insightful to you. Please do not hesitate to leave your comments, your reactions, and your questions below as you do usually, and follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.